$6 trillion evaporated in 60 minutes. If you bought precious metals at the recent top, you probably watched your portfolio bleed out in real time. This chart shows the exact trajectory of the damage. Gold was trading comfortably at $5,600 an ounce before dropping $500 in a straight line. Silver plunged from $121 down to $108. To understand a drop that steep, you have to look at how retail traders use margin. When you buy metals with borrowed money, your broker requires you to maintain a certain account value. If the price slips too far, you get a margin call, a demand to deposit more cash immediately. If you can't, the broker forcefully sells your position. This creates a mathematical trap. Forced selling pushes the market price lower. That lower price triggers the next layer of margin calls down the ladder, creating more forced selling. It becomes a mechanical waterfall of red candles, liquidating account after account on the way down. Dismissing this as standard volatility ignores the specific mechanics of how price discovery broke down. While a six-figure loss in an hour looks like random market chaos, these drops follow a precise mathematical logic. This was a triggered liquidation event, a predictable reaction to a sudden shift in global liquidity. Survival in this market depends on identifying the hidden forces that pull these triggers before the next cascade starts. The primary weapon behind this crash has a very specific name, the DXY. That is the US dollar index, a metric that measures the strength of the dollar against a basket of other major global currencies. Because gold and silver are priced in dollars, they are locked into an ironclad inverse correlation. Think of it like a seesaw. When the dollar gets stronger, it takes fewer dollars to buy the same exact ounce of metal. The dollar side goes up, which mathematically forces the gold and silver side down. On the morning of the crash, the DXY pumped hard. The dollar surged against foreign currencies, the seesaw tipped aggressively, and the metals market collapsed under the weight of the math. Most retail investors buy silver and gold without ever looking at a dollar chart. Institutional funds and hedge funds watch the DXY every single minute. By the time an average trader reacts to a red candle on a gold chart, the institutions have already sold, using the retail panic as their exit liquidity. The dollar didn't spike by accident. The Federal Reserve had just sent clear, hawkish signals to the market. They indicated they might hold interest rates higher for longer to combat sticky inflation. High interest rates give investors better yields on dollar-denominated assets, creating immediate global demand for the U.S. currency. At the exact same time, looming threats of a U.S. government shutdown dominated the news cycle. Markets despise political uncertainty. When political chaos hits, traders reduce their risk. Following a month where gold had already rallied 30% and silver 65%, institutional funds had massive profits sitting on the table. The shutdown fears gave them the perfect excuse to lock in those gains and retreat to cash. High interest rates attracted foreign capital, while domestic fear pushed investors to take profits. Both forces created a massive rush to hoard US dollars, pushing the DXY upward and executing the exact seesaw mechanic that crashed the metals. While both metals fell, they didn't fall equally. Gold dropped 9%, while silver dropped 11%. Silver is gold on steroids. It moves in the exact same direction, but with an amplified multiplier effect on both the gains and the losses. That extra volatility comes from silver's specific utility. Unlike gold, which is primarily held as a financial asset, more than half of all silver demand comes directly from industrial manufacturing. Right before the crash, new economic data revealed that manufacturing output in China was contracting. That single data point sparked immediate fear that global industrial demand for raw materials was about to dry up. This hits silver perfectly in its weak spot. The green energy sector requires vast amounts of the metal to function. Every single solar panel rolling off a production line requires silver paste for its conductive properties. It goes further than energy. The rapid expansion of massive data centers and the fabrication of advanced AI semiconductors rely entirely on silver components. Because silver is deeply embedded in these rapidly growing tech supply chains, any hiccup in global manufacturing data gives the silver market a cold. The China data hit the wire, industrial demand fear spiked, and silver's multiplier effect compounded its losses from the strong dollar. That 60-minute window of cascading liquidations was driven by pure emotion. Traders panicked, stop losses were hunted, and sentiment flipped from euphoria to despair. But that short-term fear detached completely from the underlying math. While paper contracts were burning up on screens, physical silver remained in a severe 5-year structural supply deficit. Mine production continues to deplete, while industrial consumption grows. The math for gold is equally stubborn. As retail traders dumped their positions at a loss, BRICS nations and central banks in China, Russia, and India continued accumulating physical bars at record volumes. Retail perception broke down for an hour, but the structural realities of global de-dollarization and supply shortages remained completely untouched by the volatility. This historical chart shows a pattern we have seen before. The 2008 and 2020 market cycles both featured terrifying price collapses that shook out the general public right before massive, multi-year bull runs took off. We saw the exact same mechanics play out at the end of December of 2025. 2 days of brutal, cascading liquidations and terrible market sentiment were immediately followed by record-breaking rallies in January, where silver climbed 65%. In any sustained bull market, sharp crashes serve a very specific function. They violently shake out weak hands, clear away over-leveraged traders who borrowed too much money, and reset overbought technical indicators. When the dust settles and retail traders are sitting in cash, staring at their losses, institutional money steps in. Smart money players use these manufactured moments of maximum fear to load up on physical assets at heavily discounted prices. A sudden market drop is rarely the end of a cycle. It is a highly efficient mechanism designed to transfer wealth from investors who react to emotion to those who understand the math and prepare for the volatility.